S. Pippin, that's Scottie Pippen, by the way, transferred equipment with an adjusted basis of $105,000 and a fair market value of $155,000 for its 40% interest in P. Jackson Coaching, which is a limited liability partnership. Determine S. Pippin's basis in the partnership interest and P. Jackson, the limited liability partnership, what is the basis in the equipment. So right now we're going to figure out if what's Scottie Pippen's interest in the partnership and what is the basis in the equipment. So Scottie Pippen, or S. Pippen, obtained 40% interest. This is a partnership. So what are the rules regarding partnerships formation? Under partnership formation, what's the rule? General rule, there is no gain or loss recognized. That's a general rule. It's different than what we did for corporations. Corporation is there is no gain or loss recognized if you meet the following conditions. We'll talk about the following conditions in a few minutes. So number 3, S. Pippen basis and what is it? I'll just abbreviate partnership. So this one is just $105,000, right? And what is the partnership, which is P. Jackson Coaching LLP? What is the partnership's basis in the stock? In the equipment? It's going to be the adjusted basis to the transferor, the adjusted basis of the property of the transferor, right? Plus any gain recognized by the transferor. Which in this case it's going to be the same. There is no gain recognized by the transferor, so it's going to be $105,000. Number 4. The same facts as in number 3, except P. Jackson Coaching is a C corporation. Determine S. Pippin's basis in the stock and P. Jackson Coaching, this corporation's basis in the equipment. So number 4, does S. Pippin recognize gain? If so, why? So let's review again. Under section 721, there is no gain or loss recognized. There is no control requirement. Under section 351 for corporations, there's a control requirement. What is a control requirement? Yeah, 80% or more. Unfortunately, S. Pippin did not achieve 80% on transferring the property. So guess what happens? Taxable gain. It's going to be a taxable gain. So the taxable gain would be computed as follows. The fair market value of the property received, which is $155,000, right? Adjusted basis, $105,000. The gain would be $50,000, right? If my math is correct, the gain would be $50,000. So let's do S. Pippin's stock basis. So with this one, we do need to use that equation. It's going to be basis of property. And then what are we going to add to that? Yeah, we're going to add gain recognized. And that equals stock basis. The actual equation is basis of the property transferred, add gain recognized, add cash paid, subtract loss recognized if on the rare occasion that it does happen, and we're also going to subtract any boot received or cash received. But simplified is basis of the old property, or the property that you're transferring, you add the gain recognized, that equals the stock basis. So we got $105,000, right? Plus $50,000 equals $155,000, right? Okay, so that's for the stockholder. What's the basis in the equipment for the corporation? Same equation, well, similar equation as it is for a partnership. For a partnership, it's the adjusted basis of the property plus gain recognized by the transferor, right? The exception for corporations is the exact same thing, but it's the greater of adjusted basis of the transferor plus gain recognized of the transferor plus liability assumed. There is no liability assumed, so it's just going to be the basis of the property transferred, 105,000, plus gain recognized, 50,000. So again, P. Jackson's basis is going to be 155,000.